Broadcom just had the best quarter in its entire history. Record revenue, record profit, record free cash flow, AI chip sales up 143% in a single year. They beat Wall Street on every number that mattered. And the stock dropped 14%. In a few hours, this company lost more market value than most companies in the S&P 500 are worth. Period. So how does a company crush every expectation and get punished for it? Because the real reason has almost nothing to do with the numbers you saw in the headline. First, let's be clear about how good this report actually was. On June 3rd, Broadcom reported its fiscal second quarter with total revenue of $22.2 billion. This was record revenue for the company, record profit, record free cash flow. AI chip sales surged up 143% in a single year, crushing expectations on every metric that mattered. Up 48% from a year ago. Earnings per share, $244. Wall Street expected around $240, beat. The AI business alone did $10.8 billion in revenue, up 143% year over year. Broadcom's AI segment is now growing faster than almost anything else in the entire stock market, and it's now roughly half of the whole company. Broadcom designs the custom silicon that powers the AI ambitions of the biggest names on Earth: Google, Meta, OpenAI, and Anthropic. When ChatGPT answers your question, there's a real chance Broadcom's fingerprints are on the hardware underneath. Going into earnings, the stock was on fire. It had hit an all-time high just days before, close to $480 a share, up more than 30% on the year. Everything was perfect, and that is exactly the problem. The moment the earnings call ended, the stock fell off a cliff, down 12%, then 14%. By the next morning, it was trading near $415, down from nearly $480. That's almost $290 billion in market value, gone in one session. The company beat earnings. It beat revenue. It raised its outlook for next quarter. By every traditional measure, this was a win. So if the numbers were great, what broke? The answer is three words that should change how you think about every great earnings report you ever read again. Priced for perfection. Earlier this year, Broadcom's CEO Hock Tan told investors that AI chip sales would top $100 billion in fiscal 2027. The market loved it. They bought the stock. But here's the thing about Wall Street. Once you give them a number that good, they don't just want you to hit it. They want you to raise it. Every single time. By the time this quarter rolled around, AI revenue was running so hot that analysts had quietly penciled in something bigger. 110 billion, maybe 120 billion for 2027. Some analysts at Morningstar thought 10 gigawatts of compute should produce well over 120 billion. So everyone leaned in, waiting for Hock Tan to bump the number up. And he didn't. He just repeated the old target, 100 billion, no increase. To you and me, over $100 billion sounds incredible. Because it is. But to algorithms that had already priced in 120, hearing the same old number is like getting a raise you were promised 6 months ago. It's not new. And on Wall Street, not new gets sold. Then came the second blow. Broadcom guided next quarter's AI revenue to about $16 billion. Sounds huge. It's more than 200% growth. But analysts had whispered 17 billion plus. A miss against the expectation, even while growing triple digits. This is the trap of a perfect stock. When you're priced for perfection, simply being amazing counts as a disappointment. But there's a more subtle reason, and most headlines skipped right past it. On the call, Hock Tan quietly changed the story. Broadcom had been telling investors it would sell complete integrated AI systems. The chips, the networking, the whole rack. More content, more revenue per deal, fatter future numbers. This quarter, Broadcom's leadership said something different. Going forward, Broadcom would offer chips only. That's a smaller slice of the pie. Less revenue per customer. For a stock that was being valued on the dream of capturing everything in the AI data center, we'll just do the chips is a quiet downgrade of the entire fantasy. Investors didn't miss it. The total addressable opportunity just got a little smaller. And when a stock is trading at nearly 80 times earnings, even a little smaller is a big deal. Here's the part that really makes the math nervous. There are two kinds of chip business. The old Broadcom, software and standard networking gear, was insanely profitable, with gross margins around 79%. But these new custom AI chips, the ones growing 143%, are built to order for giant customers like Google and OpenAI. And those customers have negotiating power, so the margins are lower. That means the faster the AI business grows, the more it drags down Broadcom's overall profitability percentage. Analysts now see gross margins sliding toward the mid-70s, with next quarter possibly around 74%. So you get this weird tension. Broadcom is making more money than ever in raw dollars, while making less on every dollar of sales. Trading algorithms are obsessed with margin percentages. The moment that number ticks down, the models recalculate and they sell. Add it up. No guidance raise, a softer Q3 number, the chips only pivot, and shrinking margins, all landing on a stock that had nothing but perfection priced into it. Right now, Broadcom dominates the custom AI chip market at somewhere around 70% share, but its biggest customers hate depending on one supplier. So they're funding a challenger, Marvell. Marvell has been quietly winning custom chip deals with Amazon and Microsoft. And then the bombshell, Nvidia, the king of AI chips, threw its weight behind Marvell with a strategic partnership, even calling it the next trillion-dollar company. Why would Nvidia help a rival? Because it's playing a deeper game. If customers are going to build their own chips anyway, Nvidia wants to be the one selling them the networking, the connective tissue between every chip. Even when Nvidia loses the chip sale, it still collects a toll. For Broadcom, that's the long-term risk. Its monopoly on custom silicon now has a well-funded Nvidia-backed competitor lining up right behind it. The market knows it. And when the future gets even slightly more uncertain, an 80x valuation has a lot further to fall. So here's the honest take, and this is where most crash videos get it wrong. Broadcom didn't have a bad quarter. It had a historic one. The $30 billion backlog of AI orders is real. The contracts with OpenAI and Anthropic stretch years into the future. The core business is arguably stronger than it's ever been. What broke wasn't the company. What broke was the expectation. The stock had floated so far above reality that even a perfect quarter couldn't hold it up. This was the market doing something it does over and over. It inflates a great company into an impossible one, and then it punishes it for being merely excellent. That's the real reason. Not a miss, not a collapse, a reset. When a stock is priced for perfection, good news isn't enough. It needs to be better than the impossible thing everyone already assumed. And no company can do that forever. So that's the story behind the headline. Best quarter ever, and a 14% drop all in the same afternoon. The question now, is this a falling knife? Or one of the best companies in AI suddenly on sale? Drop your call in the comments. I read them. If this helped you see past the headline, hit subscribe, because the next big earnings reset is always closer than you think. This company just made more money than ever before. And Wall Street wiped out $250 billion in response. Here's why. Revenue hit $22.2 billion, up 48% year over year. Earnings per share reached $2.44. But here's the thing. AI revenue exploded to $10.8 billion, a staggering 143% increase. Yet the stock plummeted 14%, erasing nearly $285 billion in market value. The company reiterated its $100 billion revenue target and guided for approximately 74% gross margin. This disconnect between record results and market punishment reveals something crucial about investor expectations. Subscribe to see what's really driving the markets.